What you're about to watch right now is a market event that shouldn't be possible. But it's happening. And it's happening while you watch this video. Gold just broke $4,500. Silver has crashed through $72. And every single minute, those numbers are getting lower. 4,550, 4,520, and it's not stopping. This isn't a healthy correction. This isn't profit-taking. This is a full-scale market collapse in progress. Welcome back to GeoFinance, the channel where we expose what's actually happening in markets while everyone else is distracted by the mainstream headlines. If you're new here, please hit that subscribe button right now because this is the level of analysis you simply will not find anywhere else. And if this video provides value to you, smash that like button. It helps us reach more people who desperately need to see this. I'm going to show you something today that will change how you understand markets forever. So let's dive in. Let me set the scene for what's happening right now. Friday was supposed to be the absolute worst day. Everyone thought that was it. That was the bottom. Silver crashed 38% in a single day. Gold fell 16%. The worst single day for precious metals in 45 years. Traders were wiped out, positions liquidated, margins called. Everyone in the market was watching the same screen thinking, this must be the capitulation point, this must be where the selling ends. And then Monday came. The selling didn't stop, it accelerated. This is pure liquidation cascading through the system, forced selling. Margin calls piling on margin calls. One trader's liquidation triggers another trader's margin call, which triggers another liquidation, which wipes out someone else. It's a death spiral, and nobody is stopping it. In fact, it's getting worse. The most shocking part. This morning when the markets opened, thousands of traders tried to sell their silver ETFs. Do you know what happened? Their orders were rejected. Circuit breaker hit. The exchange literally would not accept sell orders. Why? Because Friday's crash was so severe that today's prices are still below the circuit limit. Think about that for a second. People who held through the entire weekend hoping to exit on Monday morning, they're trapped, completely trapped. They can't sell at any price. The system won't let them. This is happening right now, and most people have no idea. Now, let me explain to you exactly how this is happening. The weapon in this situation is something called a margin hike. If you trade futures contracts, and this is important, you don't put down 100% of the money. You put down a deposit, usually around 10%. So if you want to control $100,000 worth of silver, you only need $10,000 as your margin, your skin in the game. This leverage is powerful. It's why traders use futures. But here's where it becomes dangerous. When the exchange decides to raise margin requirements, you suddenly need more cash, not next week, not when your bank transfer clears, immediately. If you don't have that cash sitting available right now, what happens? Your position gets liquidated. The exchange sells you out automatically at whatever price exists at that moment. And in a situation like this, where everyone is getting liquidated simultaneously, the price at that moment is absolutely terrible. Rock bottom. The worst possible exit. Now, one margin hike, most traders can survive that. They keep some cash buffer on the side for exactly this situation. But what happens if there are 2 hikes, 3, 4? What if there are 8 margin hikes in just 8 weeks? That is not survivable. That is extermination by design. And that is exactly what the Chicago Mercantile Exchange did. 8 margin hikes in 8 weeks. Each one designed to drain more cash from traders holding long positions, each one tightening the noose. They hit traders in December. They hit them in January. Christmas Day, margin hike. New Year's weekend, another margin hike. Every time traders caught their breath and thought it was safe, here came another one. The pressure was relentless, but then came the kill shot, January 13th. The CME switched to percentage-based margins. Do you understand what this means? Now, when silver rises, your margin requirement rises automatically. It's a trap that tightens itself. The higher silver goes, the more cash you need, even if you literally do nothing, even if you're just holding. And they didn't stop after Friday's massacre. Monday morning, another hike. Then another one this week. 8 total margin hikes. Let me give you some perspective on how unprecedented this is. In 2024, the entire year, how many margin hikes happened? 2. The whole year, 2. In 2023, 3 hikes. In 2022, 2 hikes. So 7 hikes in 3 years was considered normal market activity. But 8 hikes in 8 weeks? I went through 20 years of CME data. This has never happened before, not once. It's completely unprecedented. Here's what kept me up last night. This is the part that makes you realize this isn't just about market mechanics anymore. This morning, the same day as the CME margin hike, the Shanghai Gold Exchange in China also raised their margins. They increased them 20% to 26%. Shanghai, China, CME, Chicago, 14 time zones apart, opposite sides of the planet. But they both did the exact same thing on the exact same day. Now think about what that means. America and China agree on almost nothing. They're in a trade war. They exchange sanctions. They argue at every international meeting. Their geopolitical interests are fundamentally opposed. But on precious metals margins, suddenly they're moving in perfect lockstep, in perfect synchronization. That is not supposed to happen. That doesn't happen unless both governments are scared of the same thing. Both exchanges are trying to prevent the same outcome. And I think I know what that is. The math that nobody wants to talk about, the secret that's been hidden in plain sight for years. Let me show you the numbers that explain everything. On the COMEX, that's the Commodities Exchange where silver futures are traded, the ratio of paper to physical silver is 356 to 1. Let that sink in. For every 1 ounce of real physical metal sitting in a vault, 356 ounces exist on paper. 356 paper claims. 356 promises to deliver 1 actual ounce of metal. This system works fine as long as everyone settles in cash. Everyone just trades paper back and forth and money changes hands. Nobody actually needs the physical metal. It's a game of musical chairs where nobody plans to sit down. But what happens when people demand physical delivery? What happens when people say, I don't want cash, I want the actual metal, send me the silver? The math explodes, and people are demanding delivery right now. In just the 3rd week of January, 33 million ounces of silver walked out of COMEX vaults, not traded, not sold on paper, physically removed, loaded onto trucks, gone. That's 26% of everything COMEX had in their vaults in one single week. To give you perspective, 4 years ago, COMEX held 430 million ounces. Today, they hold 113 million. 74% has vanished. 3/4 of their entire inventory has disappeared. And it's accelerating. The first week of January, 7 million ounces left. The second week was similar, but the third week, 33 million. 5 times faster. It's becoming a stampede. Who is taking this silver? Not retail investors. You don't move 33 million ounces of silver with some guy with a truck. You need convoys, security, warehouses, logistics networks. This is institutional money, manufacturers who need silver for production, sovereign wealth funds, smart money. They know something retail traders don't. They're draining the vault before March, and March is critical. Here's why. March futures on the COMEX represent 528 million ounces of promised delivery. Read those numbers again carefully. 5.8 million ounces promised. 113 million ounces available. They have promised almost 5 times more silver than physically exists in their entire warehouse system. 5 times. This isn't tight. This isn't stressed. This is mathematically impossible. March 27th is first notice day. That's when every single trader holding a March contract must make a decision, cash settlement or physical delivery. That's when they have to put up or shut up. Here's the math that should terrify the exchanges. If just 22% of contract holders demand physical delivery instead of cash, the vault is completely empty. Not tight, not stressed, empty. What happens when the 23% shows up asking for their silver? This is the nightmare scenario. The absolute nightmare scenario that the CME and Shanghai are desperately trying to avoid. This is why we're seeing coordinated margin hikes from governments on opposite sides of the planet. They need to shake out the long positions. They need to force traders to surrender their contracts before delivery demands expose the entire system. And the attack is working. Look at your screen right now. Gold at $4,500, silver at $7,200. The long traders are being exterminated. But here's the smoking gun evidence. I want you to pull up two prices right now while you're watching this video. I want you to see this yourself. COMEX silver, the paper price, the price you see everywhere on financial news, $72, and falling. Now look up Shanghai silver, the physical price, the price where actual metal changes hands in China, $100. Same metal, same planet, same day, $28 difference. I need you to understand how insane this is. Paper silver in New York is trading at $72. Physical silver in Shanghai is trading at $100. That's a 39% premium on physical. If silver was really worth $72, why would anyone, especially sophisticated Chinese manufacturers who need this metal for production, pay 39% more? They wouldn't. They'd buy in New York, pay the $70 and pocket the profit. They're not doing that. They're paying $100 in Shanghai. That tells me something. They know something. They know the paper price is fake. They know $72 is a manipulated number. They know the real value of silver is much closer to what they're paying, $100. And here's what really bakes your noodle. The gap is not closing. Friday, the gap was $25. Monday, it widened to $30. Today, as COMEX crashes even harder, the gap is still $28. Shanghai is not crashing with New York. Physical is holding steady while paper is in free fall. Think about what that means. If this was a real crash, a crash driven by actual supply and demand economics, both markets would be falling together. Paper and physical would move in lockstep. They always do. But they're not. Paper is in complete free fall. Physical is stable. That divergence is the proof. The paper price is being manipulated down. Let me walk you through the data that proves what's actually happening here. First, the lease rates. Institutions pay to borrow physical silver. That rate is currently 8 to 10%. Normal? 0.5%. It's 20 times higher than normal. When lease rates spike like this, it means physical metal is hard to find. The last two times lease rates hit these levels were 1980 and 2011. In both cases, something major happened shortly after. Second, the vault drains. Every Friday, COMEX releases official data on how much metal left the vaults. Last week, 33 million ounces. We'll see this week's numbers Friday, but the trend is unmistakable. Metal is leaving faster and faster. Third, the unusual options activity. On the day before the Friday crash, unusual options positioning showed someone was betting heavily on a crash. Someone knew. Fourth, the circuit breakers being hit. Functioning markets don't freeze. Stressed markets do. And this morning, they froze. Fifth, the coordination between CME and Shanghai. Enemies moving together. That doesn't happen accidentally. Sixth, the physical premium widening. $28 and holding steady while paper collapses. That's a screaming divergence. This isn't randomness. This isn't normal market behavior. This is a coordinated attack designed to shake out long positions before March delivery demands expose the entire fractional reserve system. And it's working. Right now, this minute, it's working. But the fundamentals haven't changed. The shortage of silver is real. It hasn't gone away. It's still there. The deficit is real. Industrial demand is still growing every single day. Renewable energy requires silver. Electronics require silver. Medical devices require silver. The world can't function without it. China is still restricting exports. That policy hasn't changed. Supply growth is still constrained. That hasn't changed either. So what's changed? Only the paper price, pushed down through 8 margin hikes and cascading forced liquidation. This is where history matters. Throughout human history, every single time there's been a divergence between paper prices and physical reality always wins. Always. It took different amounts of time. Sometimes it was weeks, sometimes it was years. But it always resolved the same way. Paper can be printed. Metal cannot be printed. That's the fundamental truth. But here's what most retail traders miss during crashes like this. Crashes don't destroy wealth. They transfer wealth. Friday, massive wealth transferred from retail traders to banks and institutions who were buying. When this reverses, and it will reverse, that wealth moves back. The question is, which side are you on when it happens? That's the real game. That's what determines winners and losers. Now, I can't tell you exactly where the bottom is. Anyone who claims certainty is lying to you. Support levels that should hold are breaking like glass. Price targets are meaningless in a crash this severe. But I can tell you what to watch. First, the Shanghai Premium, that $28 gap between paper and physical. This is the truth teller. If this gap widens to $40 or $50, paper is losing all credibility in the eyes of sophisticated buyers. If it narrows because physical starts dropping, the manipulation thesis might be wrong. But if it narrows because paper rises to meet physical, that's when you know the game is changing. Second, COMEX vault levels. We get the data every Friday. If another 20 or 30 million ounces leaves this week, the vault will be nearly empty before March. The data will tell the story. Third, lease rates. If they stay elevated, institutions are desperate for physical metal. If they spike higher, the situation is intensifying. If they collapse, the pressure is releasing. Fourth, March open interest. How many contracts are still open for March delivery? If traders are capitulating, open interest drops. If traders are holding, despite the pain, it stays elevated. Elevated open interest into first notice day means delivery pressure. That's what the exchanges are trying to prevent. Fifth, system stress. Trading halts, account lockouts. If we see more of these, the system is under real stress. Functioning markets don't freeze. Stressed markets do. Track these numbers. The data tells the story before anyone else figures it out. But here's what I really want you to understand. I don't know exactly when this ends. I don't know if silver goes to $50 or bounces to $80 next week. That's not the point. The point is understanding what you're actually looking at. The margin hikes, the coordination between governments, the physical divergence, the vault drain. These are the signals that tell you something big is happening. And the question for you is personal. It's not about silver or gold. It's about your own exposure. Do you understand your exposure? Do you have an exit plan? Is your position sized for survival, or are you one margin call away from losing everything? I got a message from a trader Sunday night. He was right about everything. He had the thesis correct. He understood the fundamentals. He knew the shortage was real, but his position sizing was wrong. His stop loss got hit. A margin call wiped him out. He was right and still got destroyed. That's the difference between being correct and surviving. In markets like this, survival is everything. The winners aren't the ones who predict perfectly. The winners are the ones who manage risk, the ones who stay calm when others panic, the ones who survive until clarity emerges. Survive until clarity, then act. Let me step back and give you the big picture. What we're watching right now is a fractional reserve system under stress. The margin hikes, the vault drains, the physical premiums, they're all symptoms of the same underlying problem. The system promised 528 million ounces of silver. They have 113 million. The math is broken. They're trying to fix it by crushing long positions through forced liquidation. If they can force enough traders to surrender their contracts and accept cash settlement instead of delivery, maybe they can avoid the crisis. Maybe. But smart money is moving the opposite direction. Lease rates are spiking. Physical premiums are widening. Institutions are backing up trucks and loading metal. They're taking physical delivery while retail traders panic and sell. This is wealth transfer, and the transfer is happening right now. The question is, are you watching it happen, or are you positioned for what comes after? Paper at $72. Physical at $100? That gap closes eventually. When it does, someone profits. Someone made the right bet. The real question is who that's going to be. Look, I know this is heavy. I know it's a lot of information. But this is what's actually happening in markets right now, while the mainstream media is talking about something else entirely. They're not talking about the CME and Shanghai coordinating. They're not talking about the 74% vault drain. They're not talking about the $28 premium on physical silver. They're not talking about the March deadline and the impossible math. They're distracted by headlines. We're focused on reality. That's why geofinance exists. That's why you need to stay subscribed. This is the level of analysis you won't find anywhere else. I'm going to be covering this daily until something breaks. Because something will break. This can't continue forever. Paper and physical cannot stay $28 apart forever. The exchanges can't keep crushing longs forever. The vaults can't keep draining forever. At some point, something gives. And when that happens, you'll want to have seen these videos. You'll want to understand the full picture. You'll want to know what the data was saying before it was obvious. So subscribe right now. Drop your thoughts in the comments. Share this video with someone who needs to see it. And check back tomorrow, because we're going to have more data on the vault drains, more analysis on what's really happening, and more context on what comes next. The market is telling a story. We're just reading what it's saying. See you tomorrow.